All right, we're gonna go ahead and get things kicked off. So thank you everyone for dialing in today. My name is Ryan Staton. I am one of the managing partners here at StatonWalsh. The topic of today's presentation is politics in your portfolio. This is something that we've done past couple of election cycles. I think it's important to some of the things that we're going to share today. Spend a lot of time going through history and talking about historical relevance of markets, presidential elections, different presidential administrations. I think it's important to provide context for all of this as we go into another election coming up here very soon. To really understand that what effect markets or excuse me, what effect elections will have on markets and how you should uh, potentially position your approach to investing based on presidential cycles, what's going on, long-term goals, and things of that nature. So I won't spend a lot of time on the next slide, but the topic of the election, we have these two candidates, and they have been the topic of, and you've seen these faces and heard from them on various social media platforms, news networks, interviews, podcasts, etc. And so in this election, we have, some interesting things that are happening. We have a previous president that was unseated by a challenger that's circling back and trying to win office again. And then we have the vice president of the current administration who was put in place sort of abruptly, considering the circumstances. And so, the past couple of election cycles, we've definitely seen some polarizing effects on the way people are viewing the market, the economy. What candidates are saying, what's true, what's going to happen, what's not going to happen. And naturally, when you have that polarizing environment, you're going to develop differences of opinions on a lot of different things. The topic of today's conversation, we're going to get a little bit into policies and proposals briefly for these folks. But the primary objective here today is just talk about this is what's happening today. This is what's happened in the past, and what can we expect realistically moving forward after the results of these two candidates facing off at the polls. So I think it's important to take a look back and really focus on what's happened under previous presidents. So this chart goes all the way back to the Kennedy administration, goes back to January of 1961 when JFK took office, and it evaluates different presidencies based on their cumulative return relative to the S&P 500. So S&P 500 is traditionally a measure or an index that folks will use, industry professionals, investment analysts will use as a measure of the US stock market as a whole. It does not incorporate all companies, but it does incorporate the largest 500, many of which are big, some of the biggest players in our economy. And so this measure has traditionally been looked at as, what has the US market done? And as you could see there, over the long term, from January of 1961 until the end of the third quarter of this year, so 9/30/2024, market has done fairly well over that period of time as a whole. When we break down each individual presidency and we look at those administrations, as you know, some were longer than others. Some were 8 years, some were four, some were shorter than that in a couple cases. And so I do this to kind of frame the concept of over the long term, regardless of really who was president, the market has performed relatively well over this time frame. Now, it's a very long period of time, and I know a lot of you on this call have very different time horizons. So we're going to talk a little bit about why this data is important, why it matters, and more importantly, get into the weeds on results of elections, how markets react, what happens leading up to those results. So, going a step further, kind of breaking these down to the individual segments of their terms in office, dating back to John F. Kennedy's inauguration in 1961, the S&P 500 only posted a negative return during two presidential administrations, Richard Nixon and George W. Bush. Um, in most cases, as you can see in most presidential cycles, the S&P 500 has consistently grown in value over the long term, regardless of who's in office. And so, an interesting question, or things that I ask from time to time when we do sessions like this, is you may see people on that list that you have opinions about of whether their presidency was a success or not. And those may vary based on, what your beliefs are. The reality is that I see in many cases people will say things like, I think this person is the worst president in history. And in reality, the market was positive during their administration. So what does that mean? Essentially, the view and the perception of what the president does while they're in office and during their administration typically does not always translate down to how the market reacts to the fact that that person is the president. So a lot of times people will marry the two together and believe that they are inclusive. Whatever president is in office directly affects and drives the growth of the market. It's not always true, and in many cases, it's actually not true at all. And so we'll get into some more data on that specifically. But I always like to look at this chart because I think it's pretty um, telling of what happens over long periods of time and how sometimes when we're living in the moment today, we have a perception of the way things are going, and it may not be a full comprehensive view or a 10,000-foot view of what is actually going on, at least from a market perspective. So transitioning into, some people ask the question. It's a natural question to ask. Well, what if I only invested in during times of my preferred political party being in office versus if I just invest and stay invested? Now, I'll skip to the end and spoiler alert: getting in the market and staying in the market is usually going to be the best result. It has been the best result pretty much in every year that we're talking about here. So what you'll see there in that chart is if you get into the S&P 500, this is assuming a $10,000 investment starting in 1950 and letting that run out up until the end of the third quarter of this year. You can see that $10,000 in this case grew to almost $3.5 million, or an annualized rate of return of 8.13%. If I had just invested and basically moved to cash, get in and in the market, out of the market, and I go back and forth with that, if I had done that based on my preferred political party, if I invested only during Republican presidencies, my annualized rate of return would have been 2.78%. And if I invested only during Democratic presidencies, my return would have been 5.2%. What you can see is that an end result is still drastically different regardless. You could look at this and make the assumption that, well, if I did this for a Democratic president, it's not 8.13, but it's 5.2. Well, compounded over a long period of time, the difference between 8.13 and 5.2 is almost $3 million. It actually is about $3 million. So, what's my point here? Making investment decisions based on major political parties and moving to cash for different tenures does nothing but hurt investment portfolios. We could see by this data, looking historically, it's done nothing more than it has hurt a portfolio more than it has helped it. So, regardless of the political party that occupies office, it's important to pick an investment philosophy that you agree with, regardless of a political affiliation, and you can make changes to investment portfolios. I'm not going to discount that. I'm not going to discount the tactical nature of maybe moving money from one asset class to another. But getting out of the market altogether and moving to cash because of a fear of one political party doing something that you don't agree with or that you don't like just tends to not work out. And statistically, or from a data perspective, we see that here on the screen. So let's talk about market volatility because this is something that's going to get a lot of attention, especially leading up to election day. Naturally, when we look at election cycles or other events that are coming up, there's a measure of the market, the VIX index or the volatility index. It's the CBOE volatility index. Um, it is effectively looking at what's happening in investor anxiety, activity, it evaluates buying and selling activity. It's kind of predicting what volatility will occur in the market in any particular month. And so when you look at the average daily VIX leading up to the election, the day of election, you could see that from September on up to November, we see a fair amount of volatility that spikes. That does not mean that portfolios will go up or go down 5, 10%. You may see some trading days in the 1 to 2% range. But typically during presidential election cycles, it's not always the case. This changes every day, but traditionally the two plus percent trading days are not as common around this time. However, you will see bouncing around a little bit of up, down, flat. And a lot of that is related to um, activity in anticipation of potential results, uncertainty about specific things, uncertainty about legislation. There's a lot of different factors that play in, but traditionally we do see volatility increase leading up to election day, as illustrated by this index. And so when we look at post election day, you also see the trend that things tend to cool down a bit when you get after the election results have been decided, and then the dust starts to settle. We do see volatility cool down a bit up until inauguration day. Um, Usually that's a sign of everyone just kind of digesting what's happened, looking at the makeup, not only of the presidential administration, but who's in the House of Representatives, who's in the Senate. Is it a split government, one party, some combination? How is that going to work? How is that going to affect major legislation? And when we get to inauguration day, we flip over into a period of time early on in a presidency where you've heard a lot of presidents say, what I want to do in my first 100 days or a 100-day plan. That will shape what is realistic for the future, what the goals are, but more importantly, what the composition of Congress is, will shape what in reality can be done in the first 100 days and beyond. And so what you'll see there is varying degrees of volatility. You may see some up, some down. This is all relative to the circumstances. These are kind of averages looking back to 1992. But we see a spike in volatility, so a spike in uncertainty from markets. We see a cooling down of that, and then we get into a place where we kind of revert back to the status quo or what we had leading up to that cycle. The market, it's important to understand that the market and the S&P 500 and all these market indices, they're designed to be leading indicators, meaning they're prediction vehicles. The way markets move tend to follow what people believe will happen in the future. So if you ever listen to financial news and you hear things like, is the price of that baked in already? That terminology is a direct reflection of the fact that, for example, there's an anticipation that the Federal Reserve is going to pull back or reduce interest rates over time. The market hears that and says, well, if that's the case, these are the asset classes or the types of investments that we think long term will perform better. We allocate money to that. That helps drive up the price in the short term. And so we see good performance, even though the effect of that hasn't been felt yet. It's a prediction of where we think the market will go as a result of some of those decisions. And so going back to that first 100 days, a lot of that will play a role in what and how markets move and how predictions start to formulate on what's going to happen in 2025 and beyond. So I talked about this a little bit in a previous slide, but I do just want to touch on this briefly. I think it's important. We have folks that have asked this question. I get this question a lot all the time, not just in election cycles, but when there's geopolitical crisis, when there's stuff going on in the world. Sometimes the news can be your own worst enemy. I think we all probably understand that to some degree, because we've all reacted to it in various ways over time. But one of the number one questions we get in these types of cycles is like, well, what if I just move to cash and see what happens? Wait it out. And so if you try to avoid short-term volatility in election years, um, sometimes you can hurt yourself in terms of your performance. So if you just move to cash during presidential election years, just those years alone, and stayed in the market all other times, your performance would go from that 8.13% over the long term that we mentioned, down to 6.32. Now, the good news is that's better than picking one specific political party. The bad news is that even less than 2% loss in rate of return still translates to $2.5 million of lost investment value. So just making investment decisions based on preferred political party, not a great choice. Doing it just based on election cycles alone, especially if you do that consistency, can be harmful. We've done some of these presentations in the past, and we talk about the effect of missing the 10 best days in the market. And 10 days over a course of a year can happen in waves. You could have 3 of those days in a row. We can stack those up pretty quickly. If you miss just those days, the effect on rate of return on S&P 500 type of investment tends to be cut pretty significantly just by missing the 10 best days. And so, because we can't predict when those things are going to be, this idea of moving to cash, you either have to do it in a way that you're committed to it for a longer period of time, or you're going to try to do it in a market timing mechanism, which tends to just not work for most investors. And so, the reality is that yes, you'll see on that chart, that gray bar, there is some volatility there. There's some bigger ups and downs and some bigger swings that the roller coaster that you would have to ride. But if you were able to get through that and out to the other side, the reward for staying the course in that scenario and not moving to cash and resisting the urge to do that can be, pretty significant and definitely impactful for long-term planning. So, how do markets react after elections? When we look at the chart here, we're essentially looking at what happens the day after the election. What's been the most positive market reaction the day after? What's been the most negative market reaction the day after? What happened with the two most recent presidencies the day after election day? And then what happened approximately 2 months after election day? So the day that the election wrapped up and where the market was in terms of performance approximately 60 days later. And so, on average, since 1952, the day after the election is down roughly 1/4%. Um, the 2 months following the election, on average, are about 2%. Um, in the case of looking at the most positive reaction in the market post elections, we saw 2.2% in 2020. In the middle of the COVID crisis, where we had a massive market run up the second half of the year, we saw 2.2% the day after the election, and we saw 14.3% from the date of election until inauguration day the following year. And so, sometimes these get mixed up with the results of the election. Sometimes these are just generally a reaction to what's going on in the market environment at that particular time. Specifically when with 2020 and with COVID stimulus and the amount of money that was being pumped into the economy, the market went on a pretty historic run in a very short period of time. And it went from a bottom to a peak in a very short period of time. And so that's one thing where I think a lot of folks get caught up on this is they look at that and say, well, that's a direct result of the election. If we take a step back and we look at things from a 60,000 foot view, 30,000 foot view, excuse me, over that 60-day period of time, you could see that there was a lot of other stuff going on during that time that would indicate that there were other reasons why the market was reacting in that way. The contrast to that and the counter argument or the opposite was the most negative market reaction, which was in 2008. So post 2008 election, the day after, the market went down over 5.25%, and over the next 60 days lost almost 20%. Now, what was happening during 2008, 2009? We had an global economic crisis. We had a real estate bubble that had burst. Stocks and pretty much most parts of the market were declining pretty rapidly, and they hit their floor and their bottom in March of 2009. And so you could look at that and say that was a negative reaction to the result of that election. The reality is probably not the case. Well, I would say with a higher level of certainty, that wasn't the case. We had economic conditions that promoted losses in the market, not for any other reason, and really nothing to do with who was going to be president of the United States, but more so that, you know, a lot of banks were in a lot of trouble. Everyone was running around Wall Street like their hair was on fire, and there was a lot of things that needed to be worked out economically, and the market was reacting to that based on that uncertainty over the long term. So when you look at the most positive and the most negative, it's hard to tie those specifically to the results based on the candidate, and they more so can be specifically explained by the fact that there was just a lot going on in the economy at that time, and the reaction, the post, election day reaction from the market and the 60-day probably had nothing to do with the results of the election and more to do with, hey, what's going on in the world at this particular point in time? How's the economy performing? What's coming down the pipe in the future? What's monetary policy? How are we handling some of these things? When you look at the reaction to the most two recent presidential elections, you'll see in 2016, 1.11%. The day after the election in 2016, Trump was elected, and 6.16% over the following 60 days. That one was particularly interesting. If you watched any financial news at that time, there was a lot of people on TV that felt like that was going to be bad for the market, that election result. It didn't really come to fruition. And so there was a lot there that people thought and anticipated and tried to marry to the result of the election. Just happened to not be the case. And the same thing in 2020. You could see that the results post Biden, the election in 2020, Biden victory, we saw the market went up the 2.2%, the 14.33, which I just talked about. Some of those the biggest factors at play there were really, record stimulus, a lot of cash being pumped into the economy, a lot of programs with COVID and EIDL and PPP and other things kind of helping businesses stay afloat. And so that was really a big part of that growth in market value during that time. And so transitioning, when we talk about, well, what about the incumbent versus the challenger? So sometimes this question gets asked, like, well, if the incumbent gets reelected, does the market like that or does it not like that? How does it react? And so the day after the election, when we look at that same data since 1952, if it was a Republican incumbent, you could see there 1.07%. If it was a Democrat incumbent, average about 4.8. And the average between either party was about 2.86 or 2.68, excuse me. If you had a challenger that was a Republican that won, then you see that rate of return increases. The same for Democrats, and the average is much higher. And then below, you see neither. Generally speaking, just to kind of add some context to this chart, generally speaking, the market actually reacts more favorably to a challenging party winning the seat. So the opposite party winning, historically speaking, has been better for the market than if the incumbent party wins. So I think that's probably the most important takeaway from that. It's somewhat important. I don't know that it's always relevant, and especially when we're talking about long-term investing, what happens the day after the election. I guess it's a cool stat to look at. What it actually means for the long term, it tends to not translate. So does party control matter? If you look at annualized returns of the S&P 500 from 1950 to 2023, the thing that I see from this chart is that if you have a Democratic president and a Democratic Congress, you have decent rate of return at 8.72%, almost double that if you have a divided Congress, meaning you have Democratic president, half Democrat, half Republican in Congress. And if you have a Democratic president and a Republican Congress, which is a true split government, then that is still a greater rate of return, but 14.5%. Not quite as much as a divided Congress, but still pretty healthy annualized rate of return over those time periods. The same tends to be true on the other side when we see divided government with a Republican president, 12.2, a Republican president and a single party Congress performs a little bit better than the single party um, branch on the Democratic side. If you see a Republican president and a Democratic Congress, that has been the worst combination for the market. And so, what does this tell me? Um, Generally speaking, when I look at this, it looks to me like the market as a whole prefers a divided government. Why is that? My best guess would be that when there is a divided government, it does require a little bit more bipartisanship. Things have to get passed based on mutual agreement. That tends to be a little bit better for the collective of the population. And as a result of that, the markets are not impeded by legislation and other things and kind of left free to go to work. So, one of the big selling points for free markets is that they tend to be efficient. When we talk about the stock market, especially, markets are efficient. And if you leave them to do their business, they will come up with the results that are efficient and that are ultimately correct based on whatever conditions we're living in. And so, as a result of that, you're going to have some stocks that are winners, some that are losers, some that do absolutely nothing for a period of time. And as a result of that, that efficiency over time leads to collective growth. What we see from this chart is that seems to be true, is that when left to do what it's supposed to do, that free markets tend to work over the long term, reflected in performance of the S&P 500. And so, it's not to be cute or funny, but it seems like when everyone has to get along in DC, it ends up being better for our investment portfolios. So um, that is what the data tells us. That's not my opinion. That's not something that I just pulled out of thin air. Those are real statistics from 1950 all the way up to 2023. So this has been true for a very long time, and it's reflected in a much greater performance over that time frame. So, how did asset classes perform under the last two presidents? Why do I even show this in the first place? We were building this presentation and was looking at the data and building this chart, this one really jumped out to me, specifically because a lot of the conversations we have around investing in portfolios and the politics behind that, and what your opinions are, we see a lot of times that people will associate specific asset classes with a particular candidate. And the one that I saw that jumped out to me here is that if you look at the highest performing asset class during their presidencies, what we see for the Trump administration from 2017 to 2021, during that time, it was US growth, largely driven by a pretty large tech boom. A lot of it during COVID, the shift from work in the office to work from home. A lot of technology companies blew up. Their market value blew up pretty significantly. And so that's one of the biggest drivers of what we saw during the Trump administration. During the Biden administration, interestingly enough, we saw that commodities were the greatest performer up until the end of this third quarter of this year. And so, generally speaking, equities have performed considerably well under both presidents, with the exception of emerging markets. They're kind of the one outlier. Um, so, when um, we look at U.S. equities as a whole, a lot of parts of the U.S. equity markets have done pretty well. Um, when we look at bond indices, bonds are a tricky thing to evaluate, especially over the past several years. In a rapidly increasing interest rate environment, bonds in 2022 got hit pretty hard. And so they certainly don't look as attractive. They look a little bit more attractive on a short-term basis today because of where interest rates are. But if you look at them over those time frames, not a very attractive asset class to be in. And they have underperformed as a result of that. Um, Commodities ended up being the only negative asset class during the Trump administration, and has been the best performer under the Biden administration. Um, why that not particularly surprising to me, knowing the market and what's going on in the environment today. Where I think that's surprising is if you ask someone, who do you think would be more favorable to the commodities markets, think like oil and gas and others of that nature. I think the general consensus would be that Donald Trump during his presidency would have been more favorable for that segment of the market. But the performance of the commodities markets have actually been stronger under the Biden administration. There's a lot of different reasons for that. Some of these are heavily driven by inflation and high inflationary environment, which we've been through over the past several years. And so that's part of the reason why. But, if you put this chart in front of someone and said, which side belongs to which, I think in a lot of cases, people might mix them around or switch them up. And the reality is this is what actually happened. So I thought it was particularly interesting. um, a lot of it can be explained again by market conditions. A lot of this is driven by market conditions, not as much related specifically to the president in office at the time and what their particular actions or policies were. So let's talk a little bit. I want to shift focus and talk about some things that have come up and that get talked about pretty frequently, which is what's actually important to voters. I think this is important to understand because people will be voting based on these items. These items are also relevant to market performance in a lot of different ways. And so when we look at things like individual and corporate tax policies, that has been a huge topic of conversation. The Tax Cuts and Jobs Act that were passed during the Trump administration are set to sunset at the end of 2025. So starting January in 2026, after that sunset occurs, a lot of things that have been in the tax code over the past 8 years will start to go away. Some will revert back to the old rules. Some will go away. Some will stay. Some are considered, I say this in air quotes, permanent sections of the tax code. As we know from how legislation works and how things can change, I'd argue to say that there's no such thing as a permanent section of the tax code, um, but that's how it reads today. And so, what are the individual tax rates going to be? We've seen a drastic difference in messaging on who's going to get tax breaks, who's not, what the different policies are there. That's going to ultimately affect and some specific pieces of or some specific um, campaign items for the Harris campaign, for example, talking about taxing unrealized gains. That is, it sounds like would be reserved for a specific class of taxpayer. Whether that can actually come to fruition or not remains to be seen. It got a lot of attention. A lot of people were very confused about it. I think the same is true on the other side in terms of how tax cuts could occur. We're running a pretty steep deficit these days, a lot of debt being racked up. It's a question of what will the tax code be? How will we get to a place of, going next to spending priorities? How do we combine tax law with spending priorities and get the United States of America to a place of balancing our income and expenses, just like we do as individual participants in the economy. We have money that comes in, we have money that goes out. We have to do a pretty good job of balance our spending because we don't have an unlimited checkbook. And so the same conversations in a different way are happening amongst the two political parties. And what's the best way to get there? Is it in a tax cut? Is it in increasing taxes? Where should we be spending money and how should we be spending it? So the next area of focus is going to be on entitlement programs. We have a rapidly aging population. There are, I believe, 10,000 folks every day over the age 65 retiring. The workforce replacement rate on those folks retiring versus the next generation with millennials and Gen Z has not been keeping pace. Labor force participation is down since pre-COVID numbers. How do we replace that? How do we get to a place where we have contributing members of the economy? Ultimately, these entitlement programs require some form of contribution. Social Security, Medicare, Medicaid, all of those things are required or are run off of payroll taxes and other items, and that's how they're funded. There's some concern over Social Security specifically on how long it will be the trust will be funded before we revert to a money in, money out accounting, and that's a big point of concern. Um, Both candidates have expressed that they want to do something here. They don't want to get rid of any of these things. They don't have any plans to do so, but they want to refine these programs in their own way. That also translates to healthcare policy. Um, there's, since the Affordable Care Act, there's been many different attempts and iterations of creating some kind of healthcare system that is mutually advantageous for all members of the population. It doesn't appear that either party has been able to hone in on exactly how to do that and how those things get paid for. But healthcare policy is a huge thing. How much government assistance will exist? Will a government or universal program be created? How does it get paid for? How does that affect healthcare systems? There's a lot of different healthcare companies, by the way, out there. You think prosthetics, equipment, all these different elements of the healthcare industry. And there's a heavily aging population, which becomes very expensive to insure, to care for. And the question becomes, from an investment perspective, healthcare companies look pretty good on paper because we're going to spend a lot of money on healthcare definitely over the next 10 to 20 years based on the way the population is trending. The reality is that what does legislation do to help with that or to curb some of that growth in that world? There's going to be a heavy focus on regulation. Which industries will be more regulated, less regulated? Um, that really toes the party line. Typically, we see heavy focus on deregulation from the Republican Party and a focus on regulation and creating more potential regulation from the Democratic Party. When we talk about labor force participation, I always slot in immigration as a big part of that. Immigration gets a lot of different, it gets attention for a lot of different reasons right now. The reality is that technology and AI are not going to replace every single job, regardless of what popular belief is. There are still going to be jobs out there that need to be done by human beings, swinging hammers, doing things out in society. And so, as a result of that, we're starting to see more of a gap as those baby boomers and older generations begin to retire. Backfilling those jobs has become challenging. Like I mentioned, labor force participation is down. Healthy immigration policy is good for the economy. I think there's general consensus and general agreement on that concept. It's just a question of how strict, how much of the noise gets in the way on what ultimate immigration policy ends up being. Is it open border policy? Is it a complete closed border policy? Most likely the realistic outcome is it's a change in certain systems and processes. Like I mentioned, immigration still good for the economy in some sense. It's just a question of how much, how do you control that, and what does that legislation look like? There's very different opinions on that, obviously, and so we'll see how that shapes out. But that will help with overall viability in the economy when we talk about things like labor force participation, increasing participation in the trades and other industries. We talk about international trade. A lot of conversations here about China and tariffs specifically. Who pays for it? How does that work? That ultimately will just affect companies that export or import goods to other countries. How will any legislation affect their bottom line from a profitability perspective? I'm tying all this back into investment performance and not so much what's going to happen with that policy, but how is it going to affect US markets? Geopolitical conflicts, that's another one. I mean, when we look at things like um, what's going on in Ukraine. We look at things like what's going on between Israel and in Gaza and Palestine and those conflicts and others and Iran and Lebanon and there's a lot of different countries involved in these various conflicts right now. And so geopolitical risk is always going to present a potential risk when we talk about markets, but it's also right now a big topic on the mind of voters. How are we going to get involved or not involved in some of the things that are going on in other parts of the world? Um, I think to some degree, this particular item does not toe a party line. We've seen a divide in both parties of who supports which countries and for what reasons. And so this is something in particular that I don't know from a market perspective immediately will continue to, it hasn't affected performance in US markets. But when we talk about international markets and other areas of investing, it is something that we will have to pay close attention to as time goes on to see how these conflicts progress. And more importantly, is there a resolution in sight? So, how do voters feel about all of this? Um, Currently, this is according to the National Association of Plan Advisors, nonprofit organization that studies things like retirement planning, corporate retirement plans, and does surveys from time to time with folks. They did one for this year based on the election. And they asked both Democrats, Republicans, and in some cases, independents answered some of the questions. They asked how they felt about various topics. And so the results of that were that majority of Democrats, 55%, have an optimistic financial outlook. In contrast to that, both 37% of Republicans and 37% of independents feel the same, meaning they share that optimism. So, as you can see, the Democratic Party, generally speaking, as a result of this survey, feels pretty optimistic about the financial outlook beyond 2024. Um, Only a third of the other two parties, registered voters, feel that is independent. Audio issue. See if we get this. Sorry about that. Um, so majority of those parties don't feel overly optimistic about their financial outlook, financial futures. Concerns over unexpected or emergency expenses. 21% of Democrats said they were concerned about that. 16% of Republicans said they were concerned about that item. Concerns over the rising cost of living. 23% of Democrats, 16% of Republicans. And then concerned about the prospect of recession over the next 12 months. There seemed to be some agreement in terms of majorities here, but 67% of Democrats felt like that was a realistic possibility. And 84% of Republicans felt that there was a prospect of recession in the next 12 months. When we look at how people are reacting to this, one of the questions that was asked, what's your top investment strategy moving forward? And so several people said that they're making a proactive shift to conservative investing. Percentages broke down as 22% of Democrats said that they were going to do that. 26% of Republicans said they were going to do that, and 23% of independents. So the vast majority of all these three political parties are saying that they are going to stay the course of their investment portfolio. But you do see these percentages. In a perfect world, those would be zero, unless it was appropriate to do so based on other circumstances in their life. But generally speaking, there are still folks out there that are concerned. They think things are not going to be great for them over the next 12 to 18 months, and they are going to react accordingly in terms of how they invest their money. Now, when we look at moving across party lines, most of the voters in this survey shared the same key threats to their retirement. So things that would affect their ability to retire, to have good enough investment performance to retire. And those two things were inflation and economic recession. Both Democrats and Republicans agreed pretty closely in terms of percentages on inflation, economic recession, even closer. They both felt like those were two things that were going to be a direct threat to their ability to retire, especially in the next few years, and something that they're greatly, greatly concerned about. And so um, this is something that uh, this is what is on the minds of voters out there. These are the things that they're thinking about. And this is how many people may react accordingly to the result of an election based on a preferred political party or which candidates they think are going to address these issues best over the next 4 years. So starting to land the plane here, talking a little bit about some of the key takeaways, things I want you to take away from today's session. we talked about history. We talked about what's happened. We talked about what happened, in recent history as well. The best piece of advice that I can give is that try not to predict future outcomes based on current news. News cycles, especially during presidential elections, are a little crazy. Generally speaking, there's a lot of polarizing information. There's a lot of talk shows and things that are truly opinion based. I know they're on news networks, but they are, folks sharing their opinions. Um, One of the things that we have to be mindful of is that everything that's happening right now doesn't necessarily mean that the market is going to react day two at post election to those items. Like I mentioned, the market is a leading indicator. It's predicting well beyond what's going to happen over the next couple of days or next couple of weeks. It's looking farther into the future. And so if you try to predict future outcomes based on current news and you react to that in terms of how you invest in your portfolio, I don't know that that will be the most prudent strategy moving forward. You also want to avoid mixing political preference with the success of your portfolio. Hopefully, I've done a good enough job today showing you the statistical reason for that and the data behind why that just hasn't worked for investors over the long term. The reality is that a lot of market performance is driven by economic conditions and other things going on, less so about the idea of less so about the idea of who won the election in November. The biggest takeaway is that your individual investor behavior is more likely to affect your portfolio performance than the election. So your reactions to what you think might happen are either going to, in some cases, they could work out perfectly for you. In some cases, are going to be detrimental to long-term success in the markets. As a result of that, the best thing that you can do is keep a long-term perspective and focus on the things that are important to you in your portfolio for your investment goals long term. And why are long-term perspectives, why do they matter? This is a chart from JP Morgan's Guide to the Markets. They do a really good session once a quarter. It's pretty detailed, pretty in depth. Um, but they do a session once a quarter that focuses on things like investing principles, what's happening in the markets, all kinds of different data. This is one of my favorite charts when we talk about long-term perspectives. Again, going back from 1950 to 2023, in any one year, you can see that stocks, bonds, and a diversified 60/40 portfolio, you can see that there's been some big upswings and some big downswings in any one year. If we zoom out and we look over a 5-year rolling period, any 5-year rolling period from 1950 to 2023, so you could say like, well, what about this 5-year period? Pick any one. In rolling 5-year periods, stocks were down 2% in some cases, bonds 2%. A diversified portfolio of 60/40 stock to bond ratio was not down at all during that 5-year period of time. Now you can see it's pretty wide range, anywhere from 1 to 20%, but it was performance was not negative. If you take it out to 10 years, it gets better. If you take it out to 20 years, it gets even better for all strategies involved. And so the idea behind this is even if you're approaching retirement and you're saying, well, I'm going to be done working in a couple years, my time horizon is shorter. If you plan on being in retirement and spending money for the next 10, 5, 10, 15, 20 years, all of these conversations are relevant. Long-term perspectives still apply. Investment principles still apply, that if you pick strategies and you stick to them, you tend to fare better the longer you stay on that path. And so the point being is that you don't want to get too caught up in this idea of, well, this year was really bad, so I got to make a major change because if I continue to do this, things are just going to get worse and worse for me. The reality is that it's not what's happened over the long term. And we see that based on the measures up here in this chart up here on the screen. So to wrap things up, what's the bottom line of all of this? Parties occupying the White House and legislature are just one of many variables that can affect investments. They are not the end all be all. They do not make or break portfolios. Prime examples of this are 2008 and 2020. We talked about the chart back in 2020. best performing day post market, best 60 days after an election. A lot of that is attributed to what was going on in the economy and not so much about the presidential result. Same thing in 2008. By the way, both results of both of those elections were Democrats. It was Barack Obama and Joe Biden in 2008, and then Joe Biden as president in 2020. So same political party, two drastically different reactions. And so it's it's hard to say, if you were to make the argument that it's because of a political party or any of those things. Those two examples are really good examples of that really didn't matter. It was we were going through an economic crisis in 08 and 09, and we were also coming out of a crisis with COVID in 2020, and what was happening in the economy and what the US government was doing to help prop things up and keep things moving along business as usual. So two really good examples of where presidential elections didn't really matter much in terms of market performance. It was just kind of something that happened in the middle of a really good or really bad market cycle. And so while elections do create short-term uncertainty, the biggest point of focus should always be what are your long-term goals with your investments? That has to be the most important factor in making your decision on how you want to invest your money. If you have goals or objectives in mind, and those goals or objectives, for example, if you're 40 and you have a retirement account, generally speaking, you're not going to touch that for 20 years. Does this presidential election in 2024 make a drastic difference in what's going to happen in that account over the next 20 years? So that's a question that you would want to ask yourself as you're going through that decision-making process. If you're in a different position or you have some accounts that are for more specific goals in the short term, then you address those appropriately. But generally speaking, when you look at this thing and you zoom out and you take a breath, say, what should I be doing? Like, what's the right way to approach this? Ultimately, it's going to be based on economic conditions and what you have going on in your personal life, what needs and resources that you need to satisfy those needs, and how your investment portfolio plays a part in that. If you look at it that way and take all the other stuff out of the mix, I think you're going to be just fine. So with that, I appreciate everyone's attendance. I'm going to transition really quick. We have our disclosure page here. And I'm going to transition everything over to Q&A. So feel free to drop some questions in the Q&A box. Happy to stick around and answer them for the remainder of our time today. I know people have questions. Don't be shy. It's anonymous, I promise. All right. Well, like I said, we'll stick around for a couple more minutes. And if anyone has any questions, please let us know. We appreciate your attendance. Anyone that wants to head out and get back to the rest of their day, please feel free. Hopefully this was valuable. We appreciate it, and we appreciate all of you. And keep a lookout for some of our future webinars coming up and over the next couple months. But uh, we'll stop the recording and we'll kind of stick around here and answer any questions. And feel free, if you have anything that you'd like to ask us offline, welcome to do so. Please get in contact with myself